Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to be talking about mortgage renewals and mortgage refinancing and what is the difference and how it can save you some money and what your options are. Stay tuned, you don't want to miss this. If you're watching this video on the Team Sessa YouTube real estate channel, once again, thank you for all your comments and support. We appreciate everyone's feedback. Don't forget to leave those comments in the comment section below. And don't forget to hit the like, share, and subscribe button and the notification bell so you can get notified every single time we post a brand new video. If you want to book a free consultation with myself or Santo, don't forget you can do that in the description box below, and we'll set up some time to have a conversation and talk about what's on your mind. Now, back to the video. When it comes to mortgage renewals and mortgage refinancing, a lot of clients sometimes get those two confused. Now, for many Canadians who have a mortgage or experienced a mortgage renewal, you may fully understand the limitations and the requirements. For many younger Canadians or many first-time buyers who are in the process right now, or maybe got a mortgage in the last few years, understanding the differences and what you can and cannot do with a mortgage renewal as opposed to refinance can help you save you time, energy, and obviously money. So the best way to look at things would be to start off with a mortgage renewal. Now, for many Canadians who got a mortgage maybe in 2017, if you took a 5-year, you might be approaching your renewal this year, or if you got in 2018, probably in the next year to come. But understanding that obviously in this current time frame, with the rates being on the rise and the Bank of Canada increasing its interest rates, you may want to look at your options as you approach that window of opportunity. And for some banks, it's usually 3 to 6 months. So having a conversation with your mortgage professional about your options and strategies ahead of time can help save money and keep more money in your pocket. So when you look at your mortgage renewal, maybe you got your mortgage renewal, you're not sure exactly what to do with it. Now, it's understanding what your strategy is and how you want to move forward. For many Canadians, there's options in that renewal, depending on your bank, your institution, in regards to an open product, a 1, 2, 3, 4, 5-year, 7-year, 10-year. If you want to go fixed, you want to go variable, understanding the duration of which you're going to keep that home, for example, or if you're planning to pay off that mortgage. All depends on the strategy that you will deploy when it comes to that mortgage renewal. Now, I'm going to use an example right now from a client that we just had. And we spoke with the client basically, and they had come to us with their renewal and said, Anthony, look, we're looking to, see what the best options are. And we were able to offer them a relatively aggressive rate in comparison to their renewal elsewhere. However, the problem was that these particular clients were now self-employed. And previously, these clients were both salary and hourly, making great money. They're still making good money as self-employed individuals. But obviously, because they just established their corporation in the last few months, unfortunately, we weren't able to bring them over to a different bank as they were in a different line of work and did not have 2 years of filed income tax for their business. So basically, that led us to the point where we can either look at options to move the client to an alternative bank at a higher rate and obviously additional costs, which is not advisable, it's not feasible. Based on the client's situation, the client did not need additional funds. They would have liked to have a line of credit. They would have liked to pay off some of their smaller credit cards as part of the process. But unfortunately, because of the limitations of employment, we were not able to do that. Now, what we did do is advise the client, say, hey, looking at your renewal, maybe looking at a 2-year strategy, because that would give you enough time to have 2 years of income taxes filed for your business, and then push forward to look at the options in 2 years might be feasible and more advisable. So that's exactly what we did. We advised the client, say, hey, look, better to sign this renewal because your income has changed and we can't really move you. And getting this done right now will save you some money because obviously you don't need any more money. And right now is a good opportunity. Yes, I know you wanted the line of credit to invest more in building your business, but it will cost you money. And we started weighing the pros and the cons. And for the clients, they said staying with that renewal for the next 2 years would have saved them a ton of money. Now, when you look at refinancing a mortgage as opposed to the renewal, because the renewal you just sign back, and for these particular clients, the reason why we advised them on the renewal was because the lender did not require them to provide any additional income, no appraisal, no requalification under stress test rules, continue on the journey for the next 5 years or the next 2 years without any questions asked, as it is cheaper for that existing bank or lender to provide, that client with a great rate, very relatively close to what we were willing to offer them, but the fact that we couldn't move them was outweighing the fact of us having to try to transfer them to a different bank at a higher cost. So the bank was very, very happy. The client was very happy that we were able to renew that mortgage for 2 years and basically continue on the path. Now, although the client wanted to refinance, there are differences in that product. Because once again, I did mention with that previous client, if you're looking to refinance your mortgage, we do need to revisit obviously your income. You have to undergo the current stress test rules. There could be potential penalties and discharges and lawyer fees and other fees like appraisals that are going to be required if we move to a different lender, or if you're looking to restructure that mortgage even with the existing lender. So that means that the client can actually go up there and re-amortize their mortgage back up to, let's say, 25 or 30 years. They can basically maybe go from a fixed component into a variable component. They can get a line of credit against that mortgage based on the equity in their home. And also they can even use some of the equity in their home to pay down existing debt, consolidate it to a lower rate of interest. As a lot of times, many clients we see coming through our desk right now, they may have credit cards and lines of credits and car payments at a higher amount. And to simplify their life, we can re-amortize everything and basically simplify it into one monthly payment. Now, re-amortizing the mortgage or hitting reset on it is an option. It is all dependent on your financial situation and on your monthly expenses, because as I mentioned, rates are now a little bit more elevated than what you were currently paying a few years ago. So understanding to keep those payments in line, and the best way to make sure that you can make those mortgage payments, have a discussion with your mortgage professional about the options that best suit your needs. Remember, it's your options. It's listening to the client and understanding exactly what their request is. Now, what I'll do is give you an example of a scenario that came to us where a client was torn between a renewal and a refinance. And the client themselves were actually approaching the renewal window, but they were looking to go out there and purchase a home. And the problem was that they did not have the deposit that would be required if they were to purchase a new home. And because of that, the clients had come to us and said, look, Anth, we need to figure out a way. And I advised them, I said, look, it's going to be cheaper to go get the money from the family. If you have some friends that are willing to lend it to you, and then you pay them back on the sale and so on and so forth. The clients went out, tried to, scrape together some money, as they did have some money in investments, RRSPs, but they would have had to pay withholding tax. And basically they didn't have much money saved up in cash. They did not have any debt. They had no car payments. So they basically utilized all their money to clear themselves off of debt, which is a great thing. But unfortunately, they didn't put anything away in the event that they needed that extra cash. So what we did is advise the client in this particular case is, look, if you're looking to go out there and buy a home, the renewal's coming up. Here's your golden opportunity right now. When the mortgage matures, to avoid or mitigate as much of the cost, we'll have to put you with a lender that does offer a line of credit, because the current lender that they were with from their previous institution did not offer them the ability to obtain a line of credit. So finding a lender that was going to do that for them would have been very important, because as I mentioned, the client's objective was to go buy a home. And because they were buying a home, they need the deposit. They actually need money to put down at least the minimum, arguably 5% of the new purchase price as a deposit to securitize that transaction. So in this particular case, the clients were leaning towards a home equity line of credit as opposed to pulling out the money in cash, which was another option that we presented to the clients. But when we looked at that option, I said, you don't know if you're necessarily going to buy in the next month, 2 months, 3 months, or 6 months. So if you take out that money today, for example, as a cash out refinance, you are going to be starting to pay interest even on the variable as of today. Whereas the line of credit component, you only pay when you use it. And then because you're going to sell that house, everything's going to get paid out. You can port the mortgage over to with the new mortgage. Everything made sense. Clients were very happy. And that is the way we approached that situation. Now, for many viewers, you might find yourself in one of these two scenarios, understanding the difference between a mortgage renewal and a mortgage refinance, and obviously understanding what is possible. So obviously, because each case is so unique and individual, and understanding all the variables and components involved is very difficult to explain in a short video, it's always advised that you speak to your mortgage professional, reach out to them, and have a conversation about what options are best, especially if you have a mortgage and your mortgage coming up for renewal. Understanding your future goals, understanding where you plan to be in your home ownership journey. Are you planning to move, renovate, restructure that mortgage, pay out some debts, help some kids purchase a home? There's all kinds of options, all kinds of different solutions available to you as a consumer, especially when it comes to working with a mortgage broker. As a shameless plug here, we do work with over 30 lenders. We work with lenders that have different options, different solutions, and different products to accommodate many people's different needs. So what I'll do is I'll leave the video here. If you have any questions, always feel free to leave those in the comment section below. Don't forget to hit the like, share, and subscribe button. Hit that notification bell so you can get notified every time we post a new video. And if you did find this video helpful or know someone that would benefit from this content, don't forget to share the video with them as well. Now, we'll leave the video here. It's Friday. Wishing everyone a great and wonderful weekend ahead. And until next week, stay tuned and thanks for watching.